The webinar will begin shortly. Please remain on the line. The broadcast is now starting. All attendees are in listen-only mode.
Hello everyone and welcome to this month's edition of Payroll Question Time, a special March Spring Budget edition. So going to help everyone today prepare for year end. I'm going to talk a little bit about Spring Budget and lots more as well. Still getting people joining the show. We are still waiting as well for Sam, who we're hoping will be on our panel, but a few connection problems, so hopefully she will join us in just a moment. Of course, we've seen the Spring Budget be announced amidst a crisis, a cost of living crisis. And I think that's quite relevant in the sense that payroll has never been more connected than it is right now to financial well-being and employee wellness and all of those employee experiences bits as well. So we're going to be talking a little bit about that in more detail during the course of the show as well. But before we get into all of that, let me just run through a little bit of housekeeping. First is, please, if you have any payroll questions, whatever they might be, they do not need to be related to today's subject areas, which I'll run through in just a moment. If you have a burning payroll question you want any of our expert panel to answer, please do put them in the questions box. I will try and ask them in real time. If I don't get to them straight away, I may save them for a particular subject area we're going to be covering, but I will try and get to everyone's question if I can during the course of the show. So whatever it might be, put it in there, challenge our panel, and I will ask those questions as we go. There will also be a couple of polls today, so we want your involvement as well as our panel, so do look out for those. If you can keep your fingers on the buzzer, so to speak, and put in your responses as they come live, that would be absolutely fantastic. A little reminder that we are recording today's episode, so you don't need to scribble or make notes. We will send you a copy of the recording after the show so you can follow everything later on. And there will also be a survey at the end of the show as well. And that survey is really to ask you all what you want us to cover in a future PQT episode. So do make sure you fill that in. If there's a particular subject we haven't tackled yet or you want us to tackle in the future, that is your opportunity to define our future narrative. So do fill in those surveys, let us know what you think, and we'll try and follow that as well. And last but by no means least, I'm going to read out a quick disclaimer which just says the presentation today does not provide definitive answers to individual queries and in some places takes views on matters which are uncertain. It is not intended to be relied upon in any specific context or as a substitute for seeking advice, legal or otherwise, on a specific circumstance, as each case may be different. Now, more important bit, I'm going to introduce you to our wonderful panel. I'm going to start with myself. For those of you that don't know me, my name is Nick Day. I'm CEO of JGA Recruitment Group. We're a specialist payroll recruitment provider. I'm also the host of the podcast, the Payroll Podcast, where actually there will be an audio of this very episode being released after today's show as well, so do look out for that. I'm a Reward 300 member. I've been working in payroll recruitment now for over 20 years, so I've seen lots of change, probably never more than there's been in the last couple of years. But that's enough about me. Let me introduce you to a wonderful panel. I'm going to start from my left to right as I view it. Richard George, introduce yourself if you can, Richard.
Good afternoon, everybody. Happy Friday. Yeah, Richard George, Director of Education at the Payroll Centre.
Okay, short and sweet. That's what we like. We've got a bit of dancing going on our panel. Not sure what's going on there, but it's Friday fun time with the slides. Simon, introduce yourself to the panel as a part of the panel.
Yeah, good afternoon, everyone. Simon Parsons, Director of Payroll Compliance Strategies at Worx in the UK. I've been in the industry for some time. I joined Centerfile back in 1984 originally. So just a little while. As with Nick, I'm part of Reward 300. I chair the BCS Payroll Specialist Group and an organisation called Irene, and sit on a number of HMRC panels alongside Richard actually as well. So Richard's on a lot of the panels I'm on at HMRC and other government department areas. So yeah, I have a Master of Science in Payroll Management. I was one of the original cohort.
Fantastic. Now, I'm going to mention, in case Samantha joins us late, Samantha is Payroll Services Director at Danes Chartered Accountants. She was used to work for the CIPP as well, so a wealth of knowledge if she's able to join us later. But finally, but by no means least, Andy Nichols, if you can introduce yourself, please.
Hi, yes, I'm work for the pensions regulator, have been for the past 11 years nearly, looking at automatic enrolment, helping the payroll industry understand all that and the wider pensions landscape. But my background prior to the regulator was all in various payroll roles, and that's me.
Fantastic. In fact, we've just had a note. Unfortunately, Samantha's having a few IT issues. It looks like she's going to be unable to join us today. So it's going to be Richard, Simon, myself, and Andy leading the way on today's session. Let's talk about today's discussion topics. I don't know for everyone else if the slides are dancing like they are for me. So hopefully we'll try and move on from that. But today's discussion topics are getting ready for the new tax year, payrolling benefits and national insurance, national minimum wage and the increases, the remit of payroll and HR teams, so more of a general discussion about how we see the future of payroll in that regard. Coming soon, the SD Worx Academy, we'll tell you all about that. Pensions update being led by Andy Nichols, and if we've got time, there'll be some hot topics and a Q&A as well. So let's get everyone involved. We've got 89 people watching today's session at the moment. That number continues to grow. I'm going to get all of you involved in our first poll, and our first poll is this: how ready do you feel for the new tax year? There's going to be 3 options for you here. The first is all is clear and I'm ready to go. Still a few niggles, but we will try and get by. Or I don't feel prepared at all. The good news is, of course, whatever your response here, particularly if it's the last, that's what our panel is for. So if you've got any particular end of year questions or concerns or complexities that you want us to try and navigate, put them in the questions box. I will deliver those questions directly to our panel right away, and we'll try and get through those as we go. While waiting for those results, I will also ask our panel to comment on them when they come through. I would like to imagine that most people here, being payroll professionals, will say that they are ready to go, but there's always a few niggles, I'm sure, that we can try and navigate through. Interestingly, then, while waiting for those results, we have had a question already pop into the box. I'm going to ask that to our panel straight away. It comes in from Deborah. It says this: we are an organisation comprised of a number of legal entities. In recent months, we have seen employees who move between entities being taxed more punitively in early months. Has any of the panel heard of a change of approach from HMRC or similar issues from other employers? Richard, if I can start with you, please.
No, I'm not aware of any variation. Is it a timing issue, maybe, Simon, on the grounds of when they're seeing the change or the move that's causing a crossover? Nothing from my side.
That's right. It should all work fairly smoothly in reality, but I suspect maybe just a misunderstanding of how HMRC handle and what's happening. So in effect, you could think this is a continuous employment, so they've not changed the employer. But if you're moving them around the business from PAYE scheme to PAYE scheme, they are a leaver and a P45 starter. So the leaver process and the P45 starter needs to be appropriate, and the new employment start point needs to be operated. If you're saying, well, they joined us in 1984, so I'll put the original start date in 1984 and you've moved them to new PAYE scheme, HMRC will want to know where all the records are going back to 1984, because as far as they're concerned, each PAYE scheme is not connected at all. You're completely separate employment entities. But if the P45 process and leaver process are working correctly, it should be okay. But it may just be there's duplication occurring, different aspects there, and actually the transfer process is mistaken between what HMRC require and what we need as a business for continuous service. That's the only thing that comes to mind.
Sure. Well, maybe a question for Deborah then is how much of you, or how far back does this go? Is this a recent thing as we approach year end, or has this been something that you've noticed over a longer period of time? We'll always put that into the questions box, and we'll try and investigate that a little bit further. Right, let's see what these poll results come in then, because this will help direct our conversation as we get the results to come up. So I'll try and read them out for those that are in audio only mode. The first one is we've got, well, I can't see the percentages, doesn't it? Still a few niggles, but we'll get by. I don't feel prepared at all was at 6%. I can't see the other ones at the moment, so I'm trying to minimize that to get it on the screen.
Yeah.
So you can read out the other results because I can't see them here.
Yeah, so all clear is clear and I'm ready to go. 49%, that seems to be the highest score. Still a few niggles, but we'll get by. 45%. So it's quite close, Nick. And then don't feel prepared at all is 6.
Fantastic. So what do we think about those results, panel?
Well, you'd hope that the boss
yeah.
would be small.
Yes.
I guess
it's
there's
funny because go on.
God, sorry. Yeah, you please.
Yeah, there's a bit of a cultural thing, because I guess for some of us, tax year end hasn't really got here yet. I'll worry about it when it arrives. So there may be an element of that in there. I don't feel prepared at all, sort of thing, because it's sort of, that's tomorrow's problem. However, March is pretty much done, isn't it? So a lot of people will actually be into the new year already. In fact, I know we've started our tax year end processing for some clients. The window's open, so interesting. However, there have been a few niggle things announced by the government, aren't there? Which I think we've probably come to. What are your thoughts, Richard?
Yeah, I guess people will be a little more comfortable as well, because obviously the freezing now on tax and national insurance will reduce variation, which I would suggest is a comparatively significant easement for people when they're getting to it. But yeah, I'm kind of with you. I think we're probably still a bit early, especially when it comes to I guess the output from the tax year end. Also, how accurate have people been? How on top of all the NIC changes are people? Because obviously there's been 3 different rates of NI in the last, well, 2 different rates obviously in the last 12 months. And has that been applied correctly and accurately? Things like obviously directors and such like, where there will need to be that averaging. So yeah, I think in some respects, because we've kind of ended up where we started, is probably an easier year than usual. But I think there is a lot of idiosyncrasy in the actual fine detail.
Sure. Well, it looks like the spring statement did suggest a little bit of a period of stability, which was good. So let's jump into the new year tax year then. Let's just delve into some of this detail in a little bit more clarity. Just to follow back on Deborah's comment, she said to the panel, indeed, these are related to recent changes. So thank you for your feedback. We'll double check the process. Hopefully we can get to the bottom of that legal entity situation. But first thing here, new tax year, are you ready? Payrolling benefits, agents can potentially register rather than clients. So what are the potential ramifications of that? Starting with you, Simon.
Well, that bit's probably next year rather than this coming year, as in next year, I mean 24, 25. But it's been a bit of an angst since the formal registration for payrolling benefits in kind has come in, that agents haven't been allowed to do it. So we've certainly had a number of our clients saying, well, that's what we pay you for. And there's an element of thinking, yes, but HMRC don't allow it. So only an employer could register. So in some ways, it offers a level of flexibility. However, there are some caveats there, because of course the agent that does that would have to be tax advice approved, which is slightly different than a standard payroll agent. So potentially you're into AML due diligence and verification requirements as well with the payrolling benefits. But it is a move forward, because I'm sure for many it seemed balmy that your accountant couldn't do this for you. You had to do it yourself. But there are other things around in the tax advice market that have been a bit like that, like claiming marriage allowance and all sorts of things that have sort of hit the news, where vehicles had been used by some agents which are a bit unscrupulous and etc. So nice step forward. And there's obviously a theme emerging from this slide of HMRC seem to be pushing electronic.
Well, it's not a surprise, I would think. Tax has gone digital, right? Surely it makes sense that payroll follows suit. What's your view, Richard?
Well, I say it is it's the when rather than if,
Yes.
on the grounds that everything else is in real time now, pretty much, that we deal with, except for benefits. It kind of doesn't make any sense when we're managing everything else the way we're managing it, that we're still only making a single return annually for benefits that may possibly be amending month on month for certain individuals. So as I said, if I had £1 for every time somebody had said, when is payrolling going to become mandatory, I wouldn't have to be on this probably, because it has, there is obviously a slippery slope to it. And as you'll see from this one and obviously the next one as well, they are trying to, I guess, reduce the capability. Is it really around P11D to make it in the end, something will have to go. But the problem is,
I don't believe, Richard, that you don't do this for the love of it.
I do do it for the love of it, obviously.
Okay.
But
Are you
I
seeing
guess
the same on the pension side, Andy? Is that going the same way as which is lent towards?
Yeah, in terms of, I mean, API is the way forward. For instance, getting data from payroll into pension schemes. The local government pension scheme, for instance, is an annual return, but more and more are going to monthly data submissions. So, and the regulator perspective, we're data led. So it's, so data is key, and data is obviously electronic. Paper can obviously have data on it, which is a lot longer, to interpret.
On that, Andy, as a bit of a side, what's the sort of, obviously the dashboard's been pushed a little bit now, but what's the perception of that load? I mean, is that going to be a monthly update, do we believe?
That's all been debated in, like, for instance, annual benefit statements for DB schemes would be an annual value. So it doesn't matter when you do it. But the ideal thing will be when you log in as an individual to look at what pension schemes you've got there. When you prove that you are who you say you are, that will then ping a request to all the various pension schemes to say, have you got data for this person? And they should then ping back the latest, in my personal view. But the pension providers, I know some payroll people are excellently on this as well, to make sure we don't get anything done which makes it difficult for payroll or employers in effect. Watch this space really, because obviously, as you say, it's been delayed. It was going to be this April to August that the large master trust would have gone live, so to speak, with a form of dashboard, but obviously that's been pushed back a bit. Wait and see. But data, that is all electronic, isn't it?
A couple of questions coming in already, so thank you. I can see our attendees are still increasing. Starts at 80, we're up to 97 now. So welcome. If you missed my introduction, you have just joined us and you want to ask any questions related to tax year end or anything at all actually related to payroll or pensions, put it in the questions box and we'll get to those as we go through. And we've had a couple come in. So the first one is this: has anyone ever experienced HMRC reporting different values on the government gateway PAYE dashboard to what they have reported? We are struggling to get anyone in HMRC to support with resolving this. We can see our FPS file is correct, and it is not a software issue. For example, it all showed correctly this month, then suddenly changed. No credits listed, just the tax and NI drop, but the apprenticeship levy remained the same. We've also had it the other way. Any ideas, please?
Being the chair of IRENE, which is representative employers that electronic exchange with the government, this was born in 2012 with the introduction of RTI. So I guess we've only actually seen the dashboard for the past 5-6 years. Before that, you probably didn't see it. What some employers may not have realised is that if they go back to the 1940s when PAYE first came in, your dashboard has never balanced with HMRC. They probably just didn't ever tell you. Now, the reality is, Nick, 98% of employers are wonderfully correct and always pretty much are. And then you've got a fluctuating 2%, which kind of shifts a bit. So you may say 10 or 15% over the years have been impacted by this type of thing. 2% of 1.6 million employers is actually a large number. So there are thousands of employers that experience this all the time. And we're aware from statistical information that's been shared with us that HMRC inadvertently, either through data handled by the employer or themselves through their activity because they can't match very well, create approximately 2 million duplicates a year. They have software that tracks and monitors and scans to pick up many of those, much more than in the early days, but actually it's a regular activity, so I can feel for it. But there is a means to get round it, and that is to request a charge resolution case. Getting to get that raised is a bit like trying to phone home and get past your children to speak to your spouse. Sometimes virtually impossible, but depending on their age, because they just want to talk to you themselves. But and also people are measured on closing calls, so they don't want things hanging. But you need to insist on a charge resolution case. That will then get passed to a charge resolution team. But the reality is, and if you speak with colleagues or others in the same situation, you'll find that resolution may take 6 months to 2 years. Don't worry about it though. If you're solid and good, pay the right amounts at the right time and have the charge resolution team. Sometimes these things just magically correct themselves. What I mean is HMRC spot what the issue is and fix it, and other times they may come up for more information. But if you've got a problem and you think it will be fixed in 2 weeks, the likelihood is it won't. It will take some time, but there's an element of don't worry about it, but you do need to ask for a charge resolution case. Otherwise, you will have debt collectors come and they will bash your door down with baseball bats and start grabbing equipment and things and taking it away. So don't ignore it. But if you do raise the charge resolution case, that will stop and it will eventually be dealt with. That's just my thoughts, Richard. I'm sure we'll well experienced on this as well. Yeah.
Yeah, it's been a number of things. It's the application date of items as well can cause issues,
yes,
but not as much as they used to. Because it was always that the ERS-NI went on later, which was always a problem in the past. But as Simon said, usually it's if you have done everything correctly and you balance back exactly to your FDP, to your RTI, then it is a charge resolution to stop, I guess, the wolves from coming to the door.
Well, something to ask then, if I may, Simon. And interestingly, you mentioned 2% of 1.6 million. We've got 105 now people joining us on the webinar, and 2 people have now put posts in my question box to say they're having similar issues. So we're running at about 2% of today's webinar as well, suffering the same issues. But Emma has gone on to say then, in relation to her question that started this conversation off, should we then be paying what they say or what we think?
I would suggest you pay what you think, because if you pay what they say, they do not believe there is a resolution to be done.
No.
And you've admitted that their figures are correct. All right, so it's a very difficult situation, isn't it? Because we don't want to pick a fight with the government department, especially one that has so much power, but you're not. You're trying to get it right. So I'd stick with what you believe to be right and allow the charge resolution. But if you settle it, the charge resolution case will be closed and they will use that as you have agreed their figures are correct.
So we're now up to 3% as a third person's come to the fore with the same issue. Is that the same when
long webinar?
Is that the same? Is that the same for when there are credits unallocated?
Potentially so, although they don't see that as a charge resolution case, but they're probably a similar issue, and some of those may go back for years. So it's interesting to note you can actually request a copy of your data to review what HMRC hold. They can be a little bit reluctant to give it to you, but you can ask for it, and sometimes it's fairly evident what's going wrong, because you may find there's people with multiples, people sometimes that join that don't have a national insurance number and later come on, go into a quarantine state at HMRC. So they've actually put them on a quarantine. They phone up and say, oh, I've paid the tax, I want my tax code changing, and HMRC may say, your employer's never reported you. That usually sends a signal to myself or those that know a little bit about how these systems work, that doesn't mean the data isn't there, because you can see it on your FPS file. You know you've sent it. It means that HMRC have placed them into quarantine because they don't know who they are. Sure. And even though the identifying information has come along, they haven't joined them up. So it's very difficult.
Emma's come back to say thank you so much. This is very helpful. I think that's probably a question that other people that haven't even come forward yet probably are thankful for that support. That's what our panel is here for. So do put the questions in. And not a question, but an observation. Barbara's written, we have had a similar HMRC issue for our M11 payroll for SMP recovery, in that the recovery amount showing on our account doesn't match the EPS submitted by SD Worx. So I've got another question here that's come in. Are you aware, this relates to the second bullet point of our slide here, the P11D issue. So are you aware of any changes in P11D slash payrolling benefits for directors' loans, which can't be done month on month?
Well, no, not necessarily. I mean, I guess if you're saying you've still got to do P11D, the announcement in the February bulletin, and I think this is a bit of a shock announcement, and certainly as chair of the BCS Payroll Specialist Group, we've had a number of suppliers come and say, Simon, what's going on? Why haven't they told us about this? And we can't make the changes in time. Now, I'll put the advert slide. SD Worx file P11Ds electronically. So if you're using our services, they are electronic. The announcement in February bulletin was, one, you can no longer informally payroll. After the 5th of April, you need to register. So that's people who are doing P11Ds but payrolling through the payroll. They're saying, stop it. How serious you take that, I don't know, because that's 6 weeks notice in effect, or 5 weeks, whatever. The other aspect is they're saying for any P11D submission from 6th of April, it must be electronic. Well, that's great for announcement for 23-24, but any submission from 6th of April 2023 is actually 22-23. And of course, you bought your P11D software before. So now they're saying you can't use it if you use paper returns and you printed them all off. So what's going on? So there is a little bit of noise in the industry going on, a little bit, but I mean, Richard, you were at the meetings we've got to be careful what we say about some of the content of those, because some of them are not in the public domain. But in effect, they seem very strong that any paper P11D submitted after the 6th of April will be sent back in the post, rejected.
Yep. I think there's another angle as well, because of the way it's been written and also how it's been broadcast since. A lot of people have got to, I guess, have the view that you've now got to payroll. We've had that question a lot. Does this mean I can't do P11Ds anymore? Which obviously is not the case at all. But we've had a number of people, again, who have been very confused by the principle that they've got to payroll now. And that's certainly not the case at all, not yet.
Yeah. So the advantage of the P11D, I'm sure it shall go along with me on this, is the advantage of the P11D is you can go outside the tax year. You've got a later deadline. The disadvantage of payrolling is you have to do it in the year. If you don't, you're too late.
Yep. And therefore it's very reliant on you having all of the data at the right time.
On time.
Favorite one being obviously company cars.
Yes.
You know, company cars are comparatively complicated to payroll anyway, but if you have a large, ever-changing fleet, having the correct termination dates, end dates, swap dates can make it substantially difficult to actually manage in real time, because you're so reliant on third party. And it can be the same with anything. You could have private healthcare and the individual cancels with the provider, and you don't know possibly until 1-2 months after that date that they actually cancelled 2 months previously. So it's still unfortunately a very retrospective process, which is obviously why a lot of people still payroll. Sorry, still P11D it. But you know, the time is coming. But there are still items such as loans that you cannot payroll. So
just looking at some of the questions that come in on the back of that, one is, would correction P11Ds though still be paper-based?
And that was part of the other announcement in the employer bulletin. It's worth looking at it. If you search employer bulletin gov, I'm sure you'll find it, and it's for the February edition. You'll find that there's another section which tells you that actually all amendments, no matter what year, before 6th of April 2022, cannot be submitted on paper from 6th of April 23. So if you've got any outstanding amendments, get them in so they get there before, well, I'd say the 5th, because the 6th of April is, of course, a Saturday. So it's even worse to a certain extent. So you need to get them in But no, amendments cannot be done on paper either. They have to be electronic. And that'll be a challenge for some using software that does electronic, because amendments probably aren't, because you didn't used to be able to do them electronically. So
no, they may actually go back to when you did them in paper. Even if you do them electronically now, the amendment may have been in a paper solution that you had previously. But
yes.
And bringing it back to the dashboard again, Julie's just posted, our issue with the HMRC dashboard is with the allocation of the monies that we pay them. They always seem to have half the PAYE amount paid allocated to the following month. That has not been closed. See Simon smiling again.
Yeah, it all sounds so familiar. I mean, these are elements of, you know, these are sort of specialist areas of mine, Nick, as you're probably aware, but they do take quite a bit of effort and resource. Yeah, it is troubling. Yes, in the early days, I've got to say I've not had it recently, but in the early days, we had a client that had a demand in relation to national insurance debt because it was £1 out, which was quite funny because the tax liability was £1 up. And there's an element of why are you chasing one when it's £1 down where the other's £1 up? And so the employers allocated it wrong. And it's kind of, hold on a minute, you don't allocate a T and an N, and we haven't done for years. HMRC have allocated them, not the employer. So it's actually the HMRC error. But I think they're a little bit better in some ways. But I think there's an element of thinking, is there actually an unallocated overpayment from prior year they're offsetting against the current liability, so they keep on carrying it forward. It'd be an element of looking more in the detail, but some of these are quite forensic to resolve and take quite some effort, is the only thing I'd say. So there's an element of yeah, is it a concern? I think it is, but I'd raise a charge resolution or point it out and take help. The other angle is if you're wanting and you need an organisation to help you with that sort of thing, it's sort of contact with someone like Irene. They represent employers to the government on electronic exchange matters and see if they can help. The challenge is through the normal method of contact, you'll find it very difficult to resolve. But the organisations, even the CIPP, I'm sure if Sam was here, would tell us they can do it. They have contacts with senior people and CDIO. However, if those contacts are used, the first question they will ask is whether you've gone through the correct process. Yeah, but if you have and it's failing to get anywhere, they will then step in. But if you haven't, they'll tell you to call the employers helpline, listen to the music for an hour and a half, and log it.
We need to put the payroll career song on there just to keep people entertained for an hour. That'll just cheer people up while they're waiting.
Well, I was thinking we could put the American Payroll Association one on there, and it would drive everybody mad, wouldn't it?
There'll be a lot of people logging off before they get an answer anyway.
Last bit here, the last bit on the P11D, please. Last questions comes in from Susan. Says, we only have 40 employees on the P11D. The rest are payrolled. Surely we can just use HMRC online portal, and this should be okay to submit amended P11Ds on here as well.
You're quite right, you can. So the tool isn't actually available to you yet for it, but it will be. It's promised to be available in April, May and June. You can file P11Ds up to 500 individuals. The challenge, I mean, if I had 499, I might go, phew. I think the problem is when you come to enter them, because you'll have to enter everything manually.
Still a manual bit for payroll people to do all this fear of automation. There's always a task to be found. Let's shift it on this slightly then. We've covered, P11Ds are always a hot topic when it comes to year end. We've got a little bit of information to pass on to our audience on the national minimum wage as well, and some NI changes. Then we just moved on from the slide, but actually, I don't know if you wanted to just run through the national insurance class 1A, 1B change.
Yeah. Well, the predominance, I think, just to point out, is your class, even if you payroll, there's still a class 1A liability, and that's still annual, and it's something you pay over in July, and you've got to report. But we've had a funny year, so the class 1A rate for 22-23 is a blended rate, right? It's not 13.8%. So just be aware. So your accruals, if you're accruing values and putting aside, may all be wrong. So you've got to reassess, apply the annual rate. That's because the assessment point is the 5th of April. So it's the blended rate that applies on the 5th of April that applies to all benefits in the year. It's not when the benefit was received or anything. So you've got this funny blended rate. And then, of course, for next year, 5th of April 24, it reverts back to 13.8%. So just be aware of that. So there are differences, because that can be confusing because you're paying it in July. So we then get our years mixed up. You're paying in July for last year.
Sure.
Yeah.
And for those that want to find out documents related to the new tax year, I've put a link in the chat notes. I think it's gone to our entire audience. Find out more at payhr.uk/library. So have a look at that, and you can hopefully find any answers to your questions that we haven't tackled today in there. And Susan just commented to say thank you, Simon and Richard, for your responses to her question as well. Right, let's move over to national minimum wage, a common topic on this show. Always lots of questions related to this. We know that national minimum wage is increasing. Does that mean you need to look at your benefits packages? Also, an opportunity for all of you here to put your questions in the box if you have any related to salary sacrifice, cost of living, or anything else that may be pertinent to national minimum wage. Right, let's come back to yourself, Richard, then, and one of you can give us a bit of an overview on where we are.
Yep, so obviously the Low Pay Commission actually fulfil the review of wages in the UK. So it isn't just based on inflation. Which is why it isn't at an inflationary rate. It is average earnings increases, average mean salaries, amongst other areas. So principally, the Low Pay Commission make a suggestion to the government pre-Christmas, which is either taken or not, and obviously usually it's taken. So in principle, because of the cost of living, because of everything else, the general increase from the 1st of April is 9.7%. So that's from the 1st of April or the first full pay reference period on or after, which is also very important. People always ask, why is that? Well, principally, it's because the audit is based on the pay reference period, not on the month. So the pay reference period has to be correct for the audit, which is why we don't adjust within a pay reference period. But that's obviously a sideline. So 9.7% across the board. They've continued with the removal of the apprentice rate, aligning it to the under 18s. But where we were expecting to see change this year was the further reduction in age on national living wage. So originally it was 25, dropped to 23. This year was meant to drop to 21, but there has been a further 12-month delay on that variation. So it is expected next year that the national living wage will be 21 years old. And I guess the probable reasoning behind the higher rate of change to that group, so the 21 to 22-year-olds is over 10% this year, is I guess to bring it closer in alignment to the national living wage, so that when they do amend next year, if that's still the case, then obviously the pay gap difference will be a lot smaller, and therefore the net effect on quite a big demographic will not have such a large impact. So obviously national minimum wage, national living wage this year is £10.42. The under 22s is £10.18. It's good off the top of my head, wasn't it? I really need to get out a bit more. And on those grounds, the variation is already quite small, but we do expect that change next year. Next year, I believe, is year 10 of the plan, which is 2/3 median wage for 24, 25. But principally, it is a big increase, probably the biggest I've ever seen. We've had a lot of feedback of the concerns of the small businesses mostly, that is a substantial increase. And principally, you also have to look at it on the grounds that if you're increasing your lower paid due to the national living wage increase, it then cascades up the business. That you are going to therefore have to pay possibly a more significant increase than you were going to the remainder of your workforce as well. So lovely, the more the better, but obviously the net effect, especially on SME, is quite challenging, I would say.
What are the other considerations we need to think about here, Simon, in relation to cost of living, salary sacrifice, and it's a big subject, though, isn't it?
Well, yeah, and I'll talk about one that we haven't got listed on there, but is also affected by the national minimum wage increase. I mean, historically, we'd say national minimum wage related to those on lower paid wages, but with the increases, it's starting to capture groups that wouldn't necessarily have been considered to be lower wage maybe 5 or 6 years ago. So it is creeping up a bit. It's catching up with other wages and impacting it. So one area is statutory maternity pay alabaster rule. So the rise in national minimum wage is considered a wage rise for alabaster. So if that's affected someone's normal pay now, that in effect goes back to the qualifying week of any maternity leave calculations, and they're due a rise on the 6 weeks S&P higher rate, and it could actually impact the lower rate as well if they're only being paid 90% of, because their earnings were under the 154 or whatever it is coming up for the new year a week. So there are impacts on the alabaster principle, and you could say, oh, well, that means we just adjust it from April. It doesn't. It means you adjust it going back up to a year, up to 15 weeks, up to 8 weeks, depending on where the maternity is. So that then sort of plays into what about the benefit packages, because we're operating salary sacrifice pension scheme, we've got a bike, we do childcare, and of course we have plenty of money to get the £50 a week childcare vouchers, but now we've got this. It's now reduced it to £30 difference, but of course we're going to still let them do the 50. Well, there's an element of you could find yourself in breach of national minimum wage, because salary sacrifice reduces national minimum wage earnings. So, and if it does, then you either have to cap or think of some other means. Now, lots of employers may say, oh, that's all right, we'll deduct it off them instead. The problem is, who are they paying the deduction to? So if that's to an employer scheme, then they're paying that to an employer. And deductions for the benefit of the employer also reduce national minimum wage, so you're still in breach. You haven't actually changed anything. There may be an element of consideration. Is that the case with pensions? Why are you changing a salary sacrifice arrangement? Does that? But the HMRC guidance talks about capping, not about deducting. So it gets you to apply caps and say, okay, limit the benefit you give if that's what you're going to apply, but you can't start deducting something off them. So for example, we think, oh, well, they're buying the bike, aren't they? They're not buying a bike, you're loaning them one. They're paying you as an employer for the loan of the bike. And so it's understanding the arrangements. But it's interesting, isn't it? And of course, this all affects cost of living. And that's why the national minimum wage change is coming in is as part of cost of living activity, well, and inflation. So offsetting the inflation aspects there. But Andy may have a comment, I don't know, or thought on salary sacrifice and pensions, but there's an element of you might need to review your flex spend schemes and how your benefit packages are, because you may find they breach.
Andy?
Yeah, no, I agree with Simon. Yeah, you've got, when national minimum wage goes up, you just got to look at what you're doing with salary sacrifice, and you can't, obviously when people are on S&P only, there's no money to recover that salary sacrifice amount from. So therefore you cannot deduct it from the individual. And from a pension perspective, it's an employer contribution. So in fact, the employer is due to pay all of that without recovery from the individual, because there's no amount, unless you pay an OMP or something like that, occupation maternity pay, from which perhaps you can, if your contract between yourself as the employer and the individual allow you to do that for salary sacrifice purposes. Otherwise, possibly you put them onto normal contributions and pay normal contributions if your agreement for salary sacrifice agreement allows you to convert from salary sacrifice to contributions. Otherwise, it will become a full employer contribution, the sacrificed amount plus the normal employer contribution based on the pay the person would have had they not been on maternity leave, which will have just been increased if national minimum wage has resulted in alabaster kick-off. Yeah,
we have had
agree entirely, Simon.
I had a question coming from Tammy here that says, our pay reference period is a calendar month. If an employee works over their contracted hours and banks the hours for 2 weeks, they would fall below national minimum wage for those weeks, but wouldn't fall below national minimum wage when looked at monthly. Is this okay as the pay reference period is monthly and weekly?
So do you want me to do this one? So it's
Yeah,
pay
have a
reference.
go.
It's pay reference periods. It's not down to the calendar whatsoever. The principle of the audit of national minimum wage is what hours have been worked within the pay reference period, and that would include obviously contractual hours, extra hours and overtime, against what has been paid for that pay reference period. So there could be a situation, for instance, where some of the pay is in the following pay reference period, or for audit, it has to go back into the correct one for that calculation to be maintained for the national minimum wage, unfortunately.
Yeah, so if I just clarify what Richard's saying and agree with Richard. So the requirement is you have to pay national minimum wage, and your allowance, as Richard's pointing out, is the relevant pay reference period or the next. You can't go beyond. But when you come to actually find if there's a breach, you have to bring that forward into the relevant pay reference period. Now, if you're paying it 2 reference periods later, it doesn't count. You're actually in breach. Yeah, you can't kind of fix it. You could declare it and say, well, this is my mitigating, but you've breached national minimum wage. And the other point in that scenario is, and if that's in a new national minimum wage level arena, that breach has to be paid at the new rate, not when the work was done. So your allowance is the relevant pay reference period or the next. And a pay reference period maximum length is 1 month. So this is where it gets very problematical for quarterlies, etc., because the law says you have to have paid it within the pay reference period or the next. So if you paid it 2 months later, you've breached national minimum wage law. It's not allowed. There are exceptions to that. Directors, they don't have to be paid in that manner because they're not policed on that basis. But be careful, be very careful. This is why I always get a little bit worried when people say their weekly payroll and they pay 2 weeks in arrears. There's an element of, you might constantly be in breach. There is a get out, and that section regulation 9C of the national minimum wage regulations, which allows allocation in relation to timesheets that may allow a different extension. But even then, as Rich is pointing out, when it actually comes to audit, you've then got to kind of bring it all back to the right point to check a real breach. So take some care.
Regulation 9C, there's some good knowledge there. That's why we have you on our expert panel. I'm loving that. And Tammy's come back saying, yes, thank you. Very helpful, Richard. Very helpful, Simon. Well, look, we've got 104 people watching this on this happy, jolly Friday. Let's jump in, get them all activated again with our next poll. And this is quite interesting. I went to an event yesterday held by Caxton, which is all about linking financial wellness and financial health to the payroll process. Well, this poll is all about that as our next section of the show, which is, should the responsibility of financial wellness sit with the remit of payroll or HR managers? Response options here are payroll, HR, or it should be collaborative and shared. So put your responses in that. But an interesting topic. This is something that I don't think we'd necessarily been discussing pre-pandemic, and that now it's right in the middle of the payroll conversation. It shows, I think, just how far payroll has come. We're also, and I think we can start this conversation now while waiting for the results to come in, because the next part of the show is going to be talking about the remit of payroll and HR teams and whether or not we need more collaboration, whether collaboration is indeed improving between payroll and HR. Is that getting better? And how valued do payroll managers feel right now by their HR counterparts? So let's kick this off. Let's come to you, Andy. If we can, to start with, what's your view on the collaboration, the current, I don't know, the current state of play of the payroll professional? Do you think it's more aligned now with HR? Is it getting better, that relationship?
Yes, I mean, my recollection from the days of working in payroll was that HR could always have improved the supply of information to payroll, etc. So the payroll probably knew more about the rules and everything else. But I think as people, because all the new things keep getting added, the benefit, reward, even pensions, everything has become much bigger now. So I think the payroll, HR, finance, pensions, particularly if you work for a large employer where you've got professionals all in those areas, you have to work together really to provide help and support to the workforce. So it should be, hopefully it's a collaborative thing, but payroll have the data as well. So I think people look at their net pay, don't they? So payroll is a very good starting point for this.
One thing we do know is the relationship now between how a payroll is operated, and we're not talking about just paying people accurately on time, but the all things that, you know, the holistic things that payroll could input and influence now has a huge impact on the attraction and retention of staff. So it's much broader now in terms of the impact certainly a negative payroll operation can have. There's no point having the most strategic HR director in the world having all these wonderful ideas if at the end of the day they're not going to get it will matter. But what's your view, Simon? You're someone who's been immersed in this world for a long time. You're in a payroll HR services business. You're working with HR people and payroll people. What's your view on this relationship at the moment?
Well, yeah, and I think it's getting critically more important. Years and years ago, we could have probably said that payroll and HR could be the opposite end of the office and not talk to each other really, apart from have the occasional moan at each other by the fact they hadn't passed through the new starter information on time, etc. But these days, collaboration is essential for successful working. You know, there's so many things, but I still see it culturally as being a little bit difficult in some areas. So there is an element of change that they need to hold hands with each other a little
just
bit.
Lost Simon.
Oh, sorry. Can you hear me still?
We can hear you, Simon.
Yeah, sure. So I think
Yeah,
there's
we've
a
got it. I'll
lot
tell you
more.
what, let's get to those poll results and we'll pick up this conversation.
Yeah, let's do it.
How are those results looking, David? Here we go.
Yeah,
so I can't read those
very
percentages. I'm going to come to you, Richard. If you can read out percentages
so
for those
payroll,
listening audio only. Read out subjects and...
Yeah, no, it's fine. So obviously payroll are getting a bit slopey shoulders. 3% payroll. Very good effort. With payroll people on the call, not my problem. HR 24 and collaboratively 73.
How does that sit with you then, Richard? You've got the results. You see them in front of
Well,
you.
I think if you look at this in a couple of years' time, it'll be very, very different. But I guess going back to the original conversation, the whole collaborative nature has to be more intricate purely because of the way that the payroll job has changed. You know, 15 years ago, payroll was far more an island where it was just, you know, pay tax and sick and maternity or whatever. While now there is so much more incorporated in the role, whether it be benefit based, wellness based anyway, that I think it's almost impossible now to be insular. But I think the big change is possibly, well, especially when we look at financial wellness, is the way that people are going to be paid. There is a growing undercurrent of pay on demand, which is something I'm guessing we're going to talk about anyway. And if it hasn't touched you yet, or it hasn't come up, trust me, it will. There are already areas of organizations and certain sectors where it's already a non-negotiable, because it is becoming the norm. It's these blooming millennials, as I mentioned on the pre-call, and I'll say it again now. Everybody wants everything now. Everybody wants everything straight away, and unfortunately, pay is one of them. So that requirement of financial wellness is going to become more and more important, as whether we like it or not, a lot of businesses have to adapt to the variations caused by demanding pay. You know, it's one of those bizarre situations of, well, we don't want to give our staff money before we usually do, but it's kind of putting your head under a stone, because let's be honest, if they want the money, they're already getting it. But surely it makes more sense that the provision is free and you have the availability and awareness to give them the support as well. So there is that financial wellness aspect to it.
Let's jump back into the slides just so that people can see this and come away from the poll for a moment. I guess a broader question then, if we go back when I first started in this industry 20 plus years ago, When we dealt with HR recruitment at that time, of course, it wasn't known as HR, it was known as personnel, replacing personnel managers. And of course, they've adapted and evolved to human resources. It's evolved again. Potentially now a lot of people are no longer CHROs, we're looking at CPOs, chief people officers. So with that in mind, with the way that payroll is evolving, we're talking about now bringing pay on demand into the payroll process, looking at financial wellness of employees, which of course links to mental health and employee contributions, attraction, retention, all these wonderful things. If we're not quite sure yet where the responsibility lies, but we are all agreed, or at least 73% of us are, that we should be collaborating more, do we think we're going into an age where payroll might need a bit of a rebrand? Simon?
Not necessarily, Nick, and it's something we've debated a couple of times, because I guess that some areas would actually say, let's call payroll reward or something else. And I think it's certainly part of the collaborative group that covers it, but requires a skill set which is different. But the problem is, I think we tend to try and put something in one area only, but increasingly we need a team, and we need to operate as a team. And that's more than just a team of payroll people or HR people. That's a team that's mixed. So you need the mixed capability. And try and give some examples. So with national minimum wage, you could say that's a financial calculation in payroll, isn't it? Well, absolutely it's not, because payroll can't control when the manager opens the door and starts the time recording, or requires them to stay, or they're told to train at home with no pay, or. So there's an element of national minimum wage is about the whole business process and attitude. It's not just about the pay. And then you go into gender pay gap. There's an element of, you may be able to get the data, but the analysis and the requirement is a business thing. So you need everything joined together. So there's an element of payroll will play its part. But do I think that we should call payroll something else? I'm not sure I'm a big fan of it, to be honest, Nick. I think we should be proud of the industry and stand up, but we need to work in partnership. And historically, that may be seen as a bit of a class thing. So you're the workers, we're the managers, etc. And there's an element of it needs to be more equal in footing, and so we're equal partners in a relationship that brings value to a business. That's a little bit of the thoughts I have, but yeah.
I'm not too dissimilar. I think maybe the future that we can actually just broadens the remit of payroll. So maybe here the future title will be the remit of strategic payroll and HR. So there's a definition between those, looking at the broader impact of payroll, and I think that is the strategic element, as opposed to payroll is all encompassing at the minute. It always has been just about paying people on time, compliantly, and that still applies. But it has a broader impact on others, and I think adding the word strategic for those that are involved in that nature of work, I think will probably cover a lot of the new responsibilities that are starting to fall under the remits of the payroll profession. That's my personal view. I don't think the word needs to change, but I think there could be a broadening out of the route that you take within that industry, or where you get to. Richard, what's your view? You've worked in senior payroll management roles. Mostly a big global corporate.
Yeah, I'm so Simon. I mean, we often hear now payroll and reward is the sort of moniker that likes to sit over the top of it, but one is the other. But I guess also, taking a slightly different angle, there has never been a better time to instigate the strategic value of payroll, given what happened for the last 2 years. Obviously, employers
we wouldn't be having this conversation pre-pandemic, would we? Let's be honest.
Absolutely. So whether employers liked it or not, and whether they wanted payroll locked in a little room in the corner, then they had no choice than to use payroll strategically, reviewing what happened during COVID. But going even further than Simon's view, that whole angle of strategy, but also the understanding of the implications, is more important than ever. Let's use another example, benefits. The way we keep staff is great benefits. Salary is the short-term satisfier. And what is the most exponentially growing benefit in a business currently? Well, you'd probably say it's EV leasing. There are phenomenal numbers of people going to the likes of Tusker and various other businesses, and it looks great. it is very appealing. Nick, work for me. Here's a brand new electric car every 3 years, and we'll pay for everything, and you only pay 60% of the lease value. Well, there is so many implications to an EV leasing scheme. The effects not only on salary, on national minimum wage, taking us back to an earlier section, but also things like the difference in lease value depending on where somebody lives. There's so much integrated requirement that may well get very easily overlooked. But as payroll people, we understand those implications. You know, what happens when a lady goes on maternity? What happens when somebody's pay reduces? Well, unless you have the right scheme with the right rules behind it, and obviously exit strategies, all this stuff is really key. And I'm using that as a prime example because that's the thing we seem to be seeing so much of at the moment. But without that integral, basically centric relationship between the different parties involved, how can it work? And you can actually end up, yeah, go on, sorry.
So I'm building on what you've said, really, Richard. I think this is where the collaboration is so important, bringing it back full circle, is because with all the complexities of the particular situation you just highlighted, the reality is if the payroll professional department gets that wrong, that employee leaves that business, potentially under, you know, a cloud as well, and you see the legal ramifications of that later on and the claims that may come with it. But if we get that payroll bit wrong, it impacts on the whole process of HR as well. That's why it's so collaborative, and that focuses so much on retention. Get paid employees right correctly, in as many innovative ways as you like, but get that bit right and they'll stay and they'll be committed. Get it wrong and they'll walk out the door. Interestingly, I'm going to move it on because we've got a great academy I want to raise everyone's attention to. But I've had a comment I thought was a nice way to finish that little section from Joanna. It just says, payroll is the department that fixes the issues that HR creates. Okay, there are no HR people on this show.
I'm so
I imagine of the 99 we've got here, maybe 98 of them are payroll professionals. If there's an HR person on the show, apologies, but it made me chuckle. If people saw me smiling while Richard was going through his response, I read that, it made me chuckle. So there we are. Listen, let's jump on to the next section. We've got a wonderful academy piece I want to just raise awareness for. This show's all about raising awareness. It's coming soon. It's the SD Worx Academy launching in April. It's a unique mix of payroll, social, legal, HR, and L&D knowledge. Specialist people like Simon on this very show and experienced trainers will be making legislation clear and practically applicable, and will help you learn online and physical, live or in demand, so blended learning approaches, whether theoretical or practical. I don't know, Simon, if you have anything you want to add about what's coming, just to bring it to life for those that may be interested in finding out more about the SD Worx Academy.
Sure, and thanks for the opportunity there. The Academy is very successful across Europe. In Belgium, it's very renowned. SD Worx is a social secretariat status, which is a sort of a legal government type thing, and the training is very popular, and it's something we're bringing into the UK. I think some of the things we're talking about here today, RTI problems, national minimum wage, holiday pay, etc., are fairly complex areas. So the start of the academy is actually looking at the payroll, HR, and legal type areas of stuff that comes from specialists. So we have lawyer partners and ourselves as payroll specialists dealing with some of those. It will then expand into other areas, but it's seen as an online tool. You can go and click on a course and take. So yeah, it's coming soon. In fact, Thursday, the 13th of April, I think
Thursday,
it has its UK launch.
Of April. Fantastic. So look out for that. And of course, you'll find it on the website where you'll also find the place you can sign up for the next PQT. But before we haven't finished yet, we've got pensions to get through. Our resident pensions expert, Andy Nichols, is going to guide us through the latest updates, state age changes, and more. I'll put a link as well for those who might be interested in finding out more about what Andy's got to say. But Andy, take us away. What are the pensions updates we need to be aware of?
Well, I guess the key thing is obviously what the Chancellor announced in terms of the lifetime allowance, which is going to be removed, and it is at £1,073,100 at the moment, but from the 6th of April it becomes unlimited, and they'll obviously sort out the legislative side of that, which means that those who are that's the amount you can put into a pension scheme. Some people have got higher than that amount and they're protected, and they've got protected tax status for their pension savings. So there's a lot of okay, what does it all mean? And just waiting on DWP to clarify that. And then as the regulator, we will issue guidance and things along those lines, because it needs to be sorted out what the protected tax status for these individuals got more than the million as it was set, because obviously those people now can be saying, actually, why don't we join the scheme from the 6th of April onwards? We could go back into the scheme, or when re-enrollment comes along, will they get automatically enrolled? You may have them flagged not to be re-enrolled, because if they've got tax protected status, then as an employer you can choose not to enroll them or re-enroll them. So all that needs to be clarified. So I think the logical thing for the moment is don't do anything. If the individual says, I'd like to opt in or get re-enrolled, then that's their choice. Hopefully they've been in touch with Taxman to work out what the implications are. There's quite a lot in the background. I think that lifetime allowance being unlimited, but they're also capping the amount of tax-free cash you can take to 25% of the current lifetime allowance. So, but those with tax protected status previously probably have a higher entitlement to a tax-free allowance. So it is really messy and complicated, is what I'm really trying to get across here. So don't do anything until you get more information on it, because also as this lifetime allowance thing has gone away, the annual allowance amount you can have into a pension scheme every year put in there has gone from 40 to 60,000, whether that's DC or the defined contribution when you purchase, or whether it's defined benefit. But defined benefit isn't the amount you pay in, it's what your benefit is worth between the beginning and the end. And there's a formula behind that. So don't try and guess it. Just look for, there's obviously stuff on HMRC's website, etc., to work out what that means. But it's gone up. And for those who've already tried to take benefits from their pension scheme, there was a £4,000 cap, and that's gone up to £10,000. Or if you earn more than £240,000 currently, everything you start to earn above every £2, you lose £1 of the annual allowance. And really, the people, if you're thinking, I don't know anything about this, which is quite possible, then it's okay, because personally you're probably not affected, and you may not have people on your payroll who are affected. But you may have people affected. So, for instance, you might have people who can only, at the moment, only paying up to 40,000 in employee and employer contributions in the DC scheme, but in fact they're so well paid that they will pay more in, and you might be capping them and then giving some extra cash to compensate them for the fact you can't pay extra. Well, look, what's going to happen to that? So a lot of thought beyond payroll's remit at one level, HR, payroll, finance, everyone's got to get together. But we've also got to establish what exactly those rules are going to be. And I guess we see what the legislation actually says. So watch this space. But obviously, there's only a couple of weeks before the 6th of April, if that.
Yes.
So, yeah, we could have done with more time, really, couldn't we?
Yeah, the whole auto enrollment questions come up with us several times now. What difference does this now make to those people who have certificates of coverage? Because obviously previously you dropped them straight off the list. Well, now by rights they'll be eligible.
Sort of, but on the other hand, maybe because they're entitled to a higher lump sum based on their protected status rather than the 25% cap on the current lifetime allowance, which the government are proposing for future, then maybe they need to maintain. I don't know. I can assure you that in the background, we're pedaling very fastly to try and find out, as no doubt DWP are, to try and establish what this actually means in practice.
Well, you look like a swan, Andy. Paddling underneath. You look gracious above the water. What can I say? Go on, Simon.
Yeah.
Well, and I think, yes, so it is a watch and see for us as payroll. If we've got exemption cases, I think we just need to keep an eye on it, because we may find that suddenly the exemption no longer applies for pension AE. That's the fear. But if it doesn't, you can't assume that the software will just pick that up, because it'll have an exemption marker. So you probably need to remove it, so they then fall into either triennial re-enrollment duties. That's a question, is it? Or do they fall into ongoing monitoring, and so they'll be enrolled as soon as they become an eligible employee. And I guess those things we don't know yet, but I think we need to keep an interest in it because it may affect our scheme when the rules change.
Well, certainly we'll
As soon as I know,
Well,
I was going to say, as soon as I know, I will be communicating it, and it will go out, and then the payroll industry will know, and CIPP will publish it. Simon with all the various groups, and Richard as well with his contacts and stuff can spread the news.
Yeah, I think if my re-enrollment was April 2023, I may well be hanging fire on that one for a little bit, because I'm guessing it's still going to be pretty much up in the air in the next 2 weeks.
Yeah.
Or doing what I would normally do, because obviously a retrospective adjustment is probably going to be a better idea.
Yeah, the individual needs to know, doesn't it? The individual needs to know, do I need to continue my protected status, or can I now start to go into a scheme? What's the best thing to do, you know? So, yeah, pension schemes will need to get involved, HMRC, regulated DWP, Treasury and everything, you know, it's all to be resolved.
The
interesting thing
we can work collaboratively, Andy.
Yes.
Yeah,
The interesting thing we get every year is discussions on the tax relief status of pensions, and again, there's been nothing.
Take it away from them the speculation, because the 28th of April will be our next show. We'll be able to bring all of that to our 9 to 5 people that are here now. So rest assured, we'll bring any updates we can to the next episode. Before we do, we've got a question that's come in I'm keen to get to before we close the show today. It's a random question. It comes in from Susan. It says, we have an examiner payroll where exempt from NIC, but subject to tax. These are self-employed workers. It's a regulator question, but can these people be auto-enrolled? I know self-employed workers are not normally enrolled, so it's a bit of a random question.
If they're workers, therefore, so you're the employer and they're workers, so not employees, but they're workers, then automatic enrollment will apply. So being truly self-employed outside the scope of AE, but automatic enrollment talks about individuals such as employees who will be covered, definitely, and then people who are workers, people who work for the employer. So when you think about, for instance, Uber drivers are workers, automatic enrollment applies to them, but they're not employees.
Examiners or teachers, then it sounds like it'll apply to them as well. But it sounds
could very well be. You need to see what the agreement is. You may need to seek legal advice just to get that clarified. Yeah.
Sure.
It's about the control as well that the individual has.
And it'd be unusual for someone truly self-employed to be under a PAYE scheme.
Yeah.
So there's an element of a bit of a mixed. What are they?
And how long are they doing their examining from? Because you can postpone for 3 months, even if they are workers, which it sounds like they could be. You can postpone them for 3 months, which may take them beyond the period of time that there are marking exams, etc. Obviously, they could decide to opt in during that 3-month period.
Does the ER contribution apply?
The employer contribution, yes. So if they get automatically enrolled, or they choose to opt in and get enrolled, there'll be an employer contribution, yeah.
Yeah, exactly. Someone's come out saying exactly. Great. Well, we've hit the nail on the head there. So, well, a little Friday treat. We're finishing slightly earlier than usual. One panel member down. I want to say a huge thank you to Simon Parsons, Anne Nichols, and Richard George for joining us on PQT today. Thank you to the 95, in fact 105 as it was of you at one moment for joining us today on the show as well. Wish you all a wonderful weekend. Of course, don't forget to sign up for the next PQT, which is taking place on the 28th of April. You can sign up at sdworks.co.uk/PQT, and hopefully we'll have more information around some of the pensions issues in particular that Andrew was just talking about. A bit of an update for that show. So, of course, when you get the survey coming in, please do let us know what you want us to feature. We haven't defined the content for the next PQT yet, so this is your opportunity as our audience to put into the box when you get that come through about what you want us to cover. So please do fill that in. And I'll just wish you all a wonderful weekend. Thank you very much.
Have a good one.